Hello everyone, welcome to Structured Finance Conversations. My name is Paula Moreno, Head of Structured Finance for the Americas, and today I'm joined by Ian Rasmussen, Head of North American ABS at Fitch Ratings. Today we will discuss 2025 issuance, performance trends, rating transitions, and what's next for this sector. So let's get started. Ian, why don't we start with the market backdrop? How would you characterize 2025 issuance across ABS? Where has activity been the strongest and what's driving that pace?
Yeah, it's been a very strong pace. It's been, and it's kept up a much stronger pace than we were anticipating at the beginning of the year. Certainly after we got into April, we were thinking perhaps that the economy was going to change, which would drive originations down, but that hasn't been the case. So I think the healthy macroeconomic backdrop is certainly one of the things that's been leading the higher originations. We have seen the prime consumer assets really being an anchor for volume and origination. So autos is leading the way again this year. But we've seen activity across this space. The UCL sector, the unsecured personal loans are back in a big way after a decline in originations over the last couple of years. And we're seeing more credit enhancement and tighter guidelines with those transactions as they've come back this year.
And private credit, it has become more and more involved in ABS. How is that changing the market dynamics?
Yeah, I think the biggest impact that we've seen so far is the funding for the market. So what we've seen is an incredible increase in the breadth of private buyers looking to engage with originators in forward flow agreements or just purchasing whole loan portfolios or lightly structured securities. That has really changed the funding dynamic and can really help an originator in such a volatile interest rate environment because they can lock in future costs, and it can also be a diversification of funding, which can be helpful for originators as well.
So let's turn from supply to how the assets are performing. With tariff-driven inflation pushing CPI towards 4% and unemployment edging higher, how are these ABS assets performing? And are you seeing a difference maybe prime and subprime?
Yeah, no, it's a really good point. I would say that overall the performance that we're seeing in ABS is reflecting more and more Fitch's forecast for kind of economic performance as we get further into the year. Always the big thing to watch in ABS, because it affects the consumer so severely, is unemployment. But what we're seeing is still forecasted fairly healthy unemployment by the end of the year, with Fitch forecasting unemployment at 4.3%, and that tops out at 4.7% next year. And so that's still a fairly strong employment story. We are seeing dislocations, though, and differentiation in performance. And you mentioned kind of prime versus subprime. That's the big one, the credit segmentation. We've seen prime auto loans, for instance, hanging on very strong to like a 30 basis point delinquency rate. A&Ls have actually come down a little bit this year. Subprime is a little bit of a different story, where we're still seeing kind of at the very high rates of the index that we're still seeing. I do want to point out a couple of other points of differentiation. One is regional. So Canada is already having higher rates of unemployment, and we're starting to see a little bit more of that pressure come through in terms of performance. The Canadian credit card index, for instance, is at its highest point delinquency since 2020.
Maybe let's go to auto ABS. How are tariffs and the broader macro conditions and, of course, used car values filtering into the performance of this asset class?
Yeah, absolutely. So tariffs, there's still a lot of uncertainty with the tariffs. And the reason I say that is because at this point, it doesn't look like the pass-through of the tariffs has really happened yet. So we're expecting that to continue. Despite that, we're still seeing used prices at very healthy levels. We saw a surge in activity for car buying earlier in the year because of tariffs, people getting nervous that they wanted to buy a car before prices went up. We saw, for instance, in dealer floor plan, some of the MPR start to go down as people start to look at used cars and the demand for used cars start to go up. Tariffs, though, are also impacting equipment with a change in demand for agricultural and commodities. And I think that that's really where we expect the biggest pressure there is, I think the USDA is expecting farmers to have an increase in revenue this year, but it's coming from government payments and livestock, not produce. So there's more to come there from a tariff impact.
And are we seeing any impacts on early stage delinquencies in any of the asset classes and maybe on loss severities at this point?
Yeah, we're not seeing that yet. And so that's the reason I said earlier, what we're watching for is still some more inflationary pressure coming from tariffs as that pass-through comes up. Now, with the used car prices being so high, that has helped recovery values immensely, and that's kept losses low. The thing to be watching again is unemployment. If that picks up to a greater extent, or if tariff pressures pick up to a greater extent and inflation picks up, that can have broader implications to a consumer, and that might shift the story a little bit with the actual, the severities going up, both because recoveries are coming down, but also because default probabilities are going up as well.
And when we think, Ian, about the concept of payment priority, which is so important for ABS, which structures or collateral types are showing better resilience?
Yeah.
In this environment?
So I just mentioned the recovery story. That has really led to strong resilience across auto transactions. We've seen that across equipment transactions as well, where values have just really held on. Any time where we have security or a very essential high utility use for the product, so handset, you don't recover a handset, but it's so essential. We're seeing those really hold up. Where we're seeing a little bit, where we've just seen more volatility has been, again, in kind of lower credit segments or areas where we don't have that collateral to be supportive.
Thank you, Ian. So given those performance trends that we were just talking about, can we talk about how ratings have performed? What are we seeing in rating transitions across ABS?
Yeah, so it's interesting. Right now, across most of our sectors, we have an asset performance outlook which is negative. I would characterize that as cautious, but constructive currently. And the reason for that is the rating picture has really held up very, very strongly. So since 2023 in ABS, we've actually had a decline in the number of downgrades and negative outlooks that we've seen, and that's largely because the FELP downgrade story is kind of moved away. And what we're seeing now, downgrades are tied to idiosyncratic factors, a sector like solar that's having a lot of headwinds and issues, or bottom parts of the capital structure where we have credit segmentation.
And how have our downgrades and affirmations or outlook changes compared to previous years?
Yeah, so I think, again, we're in a benign period where we are expecting that we will see continued upgrades. We will, in areas that I mentioned before, where there's strength, we'll see continued upgrades of subordinate classes. I do want to point out, though, that originator health is paramount. Originator servicer performance can have a big implication on the performance of an ABS transaction. And so that's something to watch. It's certainly something that we're watching very closely in solar as we've had originator bankruptcies. We've had recent news of additional bankruptcies. And so that's something that we are really going to need to pay attention to as we go forward. And that could precipitate downgrades if there are sponsor or servicer pressures.
So now to what's new and evolving in the ABS market. What innovations or emerging trends are you seeing in terms of asset classes, structures, or market participants?
Yeah. I do want to call out that the consumer ABS space in general, the unsecured personal loans have really come back, in a big way this year, and the breadth of that private credit distribution has been very wide. So I want to call that out. We've also just seen more thoughtfulness about capital projects or capital efficiency, and so banks are doing things like risk transfer transactions, or other investment grade companies are doing credit-linked note type of issuance. I already mentioned private credit and the impact that that's had on liquidity and funding within the space, so that's paramount. But then kind of on top of that, we're starting to see the development of portfolio credit, diversified portfolio credit, where you have broad diversification by platform, by asset type. There's commercial, there's consumer, and can really be structured and to fit the needs of the investor. And with a kind of feeder fund context residing on top of that to allocate capital across kind of the underlying funds, we see that as a really important tool as we move forward in the private credit space particularly.
So, in private credit, any key differences in disclosures, collateral diligence, or liquidity considerations that you're seeing?
Yeah, maybe to talk about that feeder fund construct for a minute, because the reporting there is very different. You're going to see much more fund-oriented reporting. And there, the manager is key. And so you need to spend a little bit more attention to this other party who's doing credit and underwriting decisions to maintain the credit of that portfolio. There's going to be much more of a dynamic portfolio construct. And so there's going to be a lot of changing assets and so forth. And so you're going to need to pay attention to collateral eligibility and funding requirements and liquidity requirements within those structures.
Thank you, Ian. So let's close with a forward look. What's your outlook for ABS performance in the second half of 25 and into 2026?
So along the lines of our performance outlooks, we do believe that there is going to be some deterioration. And we are going to see deterioration because of the economy slowing, as I mentioned before, unemployment increasing somewhat, inflationary pressures are still persistent. Where we are, though, in kind of the rating cycle is we expect, as I mentioned before, stability in ratings. We are expecting upgrades through most of the ABS sectors across the capital structure, and where we will see performance problems, it will be much more idiosyncratic. I would say where we're watching, as I mentioned, unemployment is a really big factor. And as we get further into the year, we will see more of the pass-through of that tariff impact on inflation and what that does to general spending and the consumer.
Ian, thank you very much for your insights today. And thank you all for joining us. If you have any questions or would like to continue the discussion, please email sfconversations@fitchratings.com. We'll also include a QR code that links to this address. Thank you for watching.